Here is another strategy that you can use to trade spikes. I've been using it and it has been working for me. So I will be sharing all of the things that you should follow for you to be able to use this strategy again. It's one of the best so far. So I've been making at least $200 a day. I set a target for myself. You have to set a target for yourself too. As for me, it was $200 per day, and as you can see, it's already at 290, which means for today I'm done. So basically, this is how you should be analyzing the market. You have to watch this video until the end because I'm going to be explaining each and every aspect that you should follow when you want to trade using the same strategy. So make sure you watch this video until the end. Today, I'm going to take you through the entire process that you follow when you want to enter a trade. So we're going to start from the first stage that you should do so that you analyze your market well and end up entering your trade, and you should do it right. So make sure you follow each and every step that I'll be explaining. The first step is to open hourly time frame. As for me, I always scalp, so I use hourly time frame. But if you wish to hold, you can try using maybe weekly time frames or the daily time frames or the 4-hour time frame. So basically, when you open your hourly time frame, you're going to see the type of candlesticks that are being formed by the market. Here we can see that the candlesticks are not full, which means there is a lot of rejection when the market is what is going up. Here we have to check on the lower window. On the lower window we have a what? We have a confirmation that the market is going up. Hence, we can try to catch spikes, but since we have this arrow pointing upwards, it means the market is what? Is going up. Hence, if you are trying to catch spikes, just to know that you're not going to hold for too long. Maybe you're just trading for 1 or 2 spikes, then you're out. But I usually prefer to enter trades when the market is what is pointing downward like this. That is if you want to trade spikes going down. On Paynex indices, we trade spikes going down, but on GainX indices, we trade spikes going up. So which means on Paynex we sell, on GainX we buy. That is if you want to trade spikes. But if you want to trade against spikes, then it's now vice versa. So after checking on the hourly time frame, you have to check the way it has been moving. So if you can see here, you can see that when the market was dropping, right, it reached a zone where we can say there was a rejection around this zone. You can see that it plotted this blue zone. This blue zone was plotted by the system. It does this automatically. You can see around this zone there's a lot of rejection. That's why the market failed to cross this zone and went up. But when it was going up, you can see that it retraced a bit, then opened another candlestick, went up, retraced a bit. Here it made an impulsive move, but it rejected a bit again. But at the end of the day, it went all the way up. So basically, we are just trying to visualize what is happening. So if you can see, the market is trying to go up, but it is not giving us full candlesticks or candlesticks that give us more confidence that the market is going up. So it's going up, but it's retracing a lot, right? But now, what do we have? This is a candlestick we call a hammer. So this is a hammer. Usually, a hammer is a candlestick that will be giving you a signal that the market is what is going up. So now we have another candlestick which is bullish, which means our market is most likely to go up. So since the market is looking like this, it would be hard for you to place sell entries. That's why I always tell you to first check on the hourly time frame. So we cannot look for spikes here because we can just catch 1 or 2 spikes. If we keep on holding that trade, we might end up losing. Imagine if you had entered here, then enjoyed 3 spikes, then you kept on holding. Check now what could have happened. It's now going up. You would lose a lot. So make sure if you are trading against the trend, make sure that you are what? You're just scalping, you're just catching 1 or 2 spikes, but it's risky. It's better to trade when the market is trending according to the direction you want to trade. Basically, the market was selling here. So it could have been better if you would have entered sell entries here. So make sure before you do anything, you will move on to the hourly time frame, then you check the type of candlesticks that will be there. For instance, if we had analyzed our market during this time, we could have seen that the market is ranging around this zone. You can see that the market was going up, then goes down, going up, goes down, going up, goes down. It could have been easier for us to enter sell entries here. Why? Because here there's a break of what? A break of structure. We have the market was going up, but here it crossed this zone. So it means the market had confirmed that it is now going down. Plus, it had made a lot of engulfing bars, which means there was now a chance for us to catch spikes. So basically, it's wiser for you to look for sell entries when the market is looking like this, like what happened here, right? But if it is looking like this, it's better to avoid it, guys, because you might end up losing a lot of money. So basically, this is what you should be doing. Then the next thing, after identifying the current candlesticks and the current confirmation on this lower window, right? The next thing is to check how the market has been moving. We have these blue lines and red lines. The red lines are the support. We call them the support because they show us the rejection where the market is most likely to go up. You can see here it reached this support level, then it started to go up. Then these blue lines, they act as the resistance lines. So they show us the zones where the market is most likely to what? To go down, right? So basically it is saying the market can pull back to this zone, which is 1, 2. Between these lines, the market is most likely to drop. But if you can check clearly, you can see that around this zone, we have a lot of resistance, right? You can see that we have a lot of shadows. Shadows, some they call them shadows, some they call them wicks, but we can just say there's a lot of rejection here because you can see the type of candlesticks that are here. So which means it can reach this zone, then reject again around this zone. So this could be an opportunity for you to enter sell entries. That is if you want to trade spikes, but you have to wait for the right confirmation before you place any trade. So now we are now moving on to another chart. So here this is Ganex 400. When you are trading synthetics, guys, you don't expect the market to move the way you want. You trade what you are seeing, right? There are certain scenarios whereby the market cannot follow those basics or those concepts that we all learned. So sometimes it's easier for you to visualize that, right? So let's say today the market is what is making false breakouts. What am I supposed to do now? For instance, we all know that whenever a market reaches an order block, it should give us spikes. But check what happened here, right? Check what happened here. The market was acting well, it was spiking around this order block. But check what happened. Here it crossed that order block and went down until it gave us a spike, but it was too late. So if you see that you place your trade here, yeah, or you place your buy entries here, then it gives you maybe 10 ticks without spiking. Close that trade. It's better to close it. It's better to cut off the loss. Then you look for another trade, right? Maybe you might enter it some other time. Let's say here it starts to spike. Then just wait for it for the break of structure, which could be here. So for us to confirm that the market is now going up, it has to break this zone because we can see that there was a lot of resistance around this zone. So the only way for you to be able to enter your trade, it has to break the structure. Let me try to use 5 minutes time frame so that you can see clearly. So you have to wait for the break of structure. After that break of structure, then it could be easier for you to place your buy entries. So here, what do we have? We have what? This could be our zone where we anticipate that if the market breaks this zone, we are now anticipating a bullish movement. And guess what happened? Here, after crossing this zone, it just made a short retracement. So you can now enter your trade when it crosses this zone after that retracement. Check if you place your buy entries here. Could enjoy this upward movement. This upward movement can only hold it, guys, when there is no order block on the other line, on the other side, which could be the left side. So let me go to the hourly time frame and show you what I'm trying to elaborate here. You can see here we are saying this was our zone where we can say the market should break, right? Why did we hold? We could hold this trade because you can see here there's no order block. The only order block we are seeing is this one. So it means once the market reaches this order block, that is when you start to be careful. You know you cannot hold that trade for too long because it can turn because of this order block. You can see here we once had an engulfing what? an engulfing bar whereby this bullish candlestick was engulfed by this bearish, and we had a pin bar just after that candlestick. We mean this is now the confirmation to drop. And check what happened. It dropped further. So basically, once it reaches an order block, you now have to be careful. You now have to monitor it well so that it does not take your profit. But to some people, we can say if you had entered your trades here, you could have enjoyed one, two, three big candlesticks on the hourly time frame. It could be wise for you to take profit and leave that trade. So let's check another pair so that we see how we are going to be analyzing the market using our strategy. So basically, what do we have here? Here we have a PIN 600 chart. So what are we looking at? We have to check on the hourly time frame first. Let's check on the hourly time frame so that we see what we have on the hourly time frame. Here is the hourly time frame, right? On the hourly time frame, I'm seeing a drop. Here you can see that there is a drop. Then I'm also seeing a ranging market. There is a ranging market here. Like what I told you, you open your hourly time frame, you look for the candlesticks, you look for the entry, and then you check the confirmation. Here on the confirmation, what do we have? It's a buy, which means the market is trying to go up, right? But here on the signal, we have a sell entry. So since the signal is saying there's a sell entry, if there's a chance for us to catch spike going down, that's the first thing you should note. Then secondly, this signal is saying the market should go up, which means there is a chance for the market to go up again. So you now have two signals. Basically, you are not allowed to hold that trade for too long. So in the event that you want to trade on a ranging market, you just have to know that you're going to place your trades on that zone where the market is playing a lot. So let's shift to the 5 minutes time frame so that we can see the point we can enter our trade. So here, what do we have? For you to confirm that it's a ranging market, it has to have what we call the equal laws. So here we have equal laws like this. It does not have to be equal exactly, but you can see that it turns around the same zone. So here we can see that we have equal lows, right? Then if we move this, we now have equal highs. We can see 1, 2, 3. So we have equal highs now. So how do we place our trades? We have to wait for the market to reach this zone where we are saying we have equal highs. You can see that it was highlighted by this yellow zone. So since you have identified these equal highs, what you have to do is you now have to wait for a spike. If it reaches this zone, the yellow zone, then it gives you a spike. Then the next thing you should do is to place your sell entries. So basically, we had our first spike on this yellow zone and it reached this zone. So which means you're going to place your sell entries here. This is where you're going to place your sell entries and enjoy the downward movement. Usually, it should spike until it reaches this blue zone. Here we have what? We have these two double lines. These are the ones that will be showing us that there's going to be a rejection around this zone. But if it crosses that rejection zone, what do? You can add sell positions because it has confirmed that the market is now going harder. So basically, here we should have placed our sell entries here and managed to catch these two spikes. You have to monitor it because you can see here we have what? We have a support here whereby the market once went up. You can see the market once went down, then reached this zone and started to go up. So you have to monitor it. It can pull back again to this level. So in the event that you had not managed to enter your sell entries here, you don't have to enter now because it's now on the support. It can retrace to this one. So the best way for you to enter if you are late is to wait for a retracement. So it's either it's going to retrace back to this yellow zone, then you can place your trades here and enjoy the downward movement. Basically, we call a breakout here. Many people could say, it's now time to place our sell entries, but no. The best way is for you to wait for it to retrace back because you have already identified that the market is ranging since we have equal lows and equal highs. As long as we have equal lows and equal highs, we have to wait for the market to retrace so that we can place our entries. So now you have to wait for the market to retrace back to this one. Then you can place your sell entries. So where are you going to place your trades? You say they're going to place your trades here. there are a lot of ways to enter trades here. You can place your trades here since we know that around this zone, this is where we are supposed to enter our sell entries. Or you can place your trades here. But you can just start using small lot sizes here. You wait for it to pull back to this zone. Then you just place sell entries here. Then you wait for it to pull back or to just spike. If it spikes, then you know it has confirmed that signal. So there is a chance for us to catch more spikes. So basically, that is what you're supposed to do when you want to analyze the market using the system. You have to check the overall behavior of the market. You have to see how the market is behaving according to that day. Because the market, when you are trading synthetics, they don't move the same way every day. Sometimes they can be used, they can be moving according to breakouts. Sometimes they can be moving according to order blocks. Sometimes they can be moving according to manipulation. So basically, that is how you trade using this simple system. You can also trade a small account, but make sure that you apply money management skills because you have to manage your money well. Most people are failing to manage their money. That's why you end up blowing. You make $100 a day, you make $500 a day, but you lose 1,000 a day. So in generally, the money management concept will not be practiced if you are doing such kind of problems. So make sure you do it well and analyze your market well. It's actually easier for you to trade a ranging market or a trending market because you just know what, when the market is what is going up like this, then it has to spike this around the zone. If it doesn't spike, then it means it is rejected. So it means you're not going to continue holding that trade. You're out. So basically, this is the easiest way to scalp when you want to trade spikes.